Hello, hello everyone. Welcome back. Welcome back to the chat room. This is Ed Ponzi. It's great to be here with you today. I'm speaking to you on the 8th of September 2014. I hope you're well. It's a Monday. Let's start off to another week here in the U.S. Market's down slightly, as you can see by our current candle here. We're going to start off talking about stocks, etc., because that's where there's plenty to talk about in Forex, but there's nothing that's happening right this second in the Forex market that requires our attention. On the other hand, there's probably quite a few things that we could take a look at in terms of stocks, and indeed we're going to take a close look at the non-farm payroll report that occurred on Friday, and that's going to concern both stocks and currencies. But the thing I wanted to draw to your attention first, we are looking at a chart of the S&P 500. The INX, $INX daily, is the S&P 500. That's one of the one of the signs that signals that represents it. And you can see I've drawn. First of all, we're very much in a confirmed uptrend. You can see all the bounces off of the 100-day moving average that have kept this party going now for years, and we're way above the 100-day moving average now. So do we pull back toward it, I guess, is the question, right? Because every time we extend too far away from it, we come back. That seems to be the pattern. And now once again, we're extended. We're right at 2,000. We've been sitting right at 2,000 pretty much for 2 or 3 weeks at this point. Take a good look at this line right here. This is 1990. We were hitting a lot of resistance in that area before. That 1990 was resistance on 7/24. We had a high actually of 1991. That's on July 24th. And 1990 was support on August the 28th and September the 5th. So that's the important level right now. 1990 is your important level. You can see how we bounced off of it twice. It was resistance. Now it's support. As long as we hold above that, we're still in an uptrend. But I would just point out that this trend has been pretty flat lately. We also have that moving average. That 100-day moving average is pretty far down from here, right? Long way down. So, right now we're kind of in a holding pattern. We've really been stuck in about a 20 point, I almost said pip. We've been stuck in about a 20-point range on the S&P 500 since August 25th. All right, so we're 2 weeks, we're 2 weeks into this thing where we're just sitting here waiting for the price to move one way or another. And there's really been no catalysts. Big catalyst later this week could be Apple. On Tuesday, Apple makes, usually once a year, Apple has a big event, and they invite all the press, and they introduce new products, and that's tomorrow. And of course, we're long and strong Apple. We have been for a long time. Apple took a big hit last week because someone said it's gone up too much. But look, we've done really well on this stock, and actually, that's pretty cool looking. That's actually a decent pullback. I don't like to see them come down that hard when I own them. I prefer to see them float down like a feather instead of like a rock. But as far as for now, we'll take it. If you're not in this already, we're up a bunch on this one, but if you're not in this already, that 100-day moving average, if you could see big movement in Apple tomorrow, 92 I would buy if you're not in here. Don't buy now if you're not in. Wait, and if it does get slammed tomorrow, I might take a position at 92 if I were looking to get in. For me, I'm already in. I've been in, and I'm up about 25% on my Apple position, and we did it all here live in the room, and so I'm sure some of you folks have done well also. JCPenney, we're up about 25% on that one too, close to 30%. It could be 30% actually at this point. JCPenney hanging around 11. Having a little trouble with the 11 area, but there's plenty of upside for JCPenney. This could be more to do with the market than anything else. Dean Foods, a little bit of green for Dean today. This has not exactly been our friend, but it hasn't hurt us really badly. And again, this is a type of stock that could get bought out. That's really why we own it. On the other side of the ledger, we did make some changes. We got rid of TJ. First of all, we got rid of TJ Maxx. It was down a little bit today. It had been going up. It's you know, the market doesn't look like this is stronger than the market. So it's crazy to hold on to it. So I dumped this thing. I'm holding steady with Lulu. Still good and short on Lulu. And I entered Kimberly-Clark. We're still short Kimberly-Clark. No regrets there, my friends. This is basically where we shorted it. It has gone nowhere, and this is definitely weaker than the overall market. Kimberly-Clark, way off its highs, right? So we like that. I have some new shorts. What I did, I got rid of TJ Maxx and I put the proceeds into 2 stocks because I really don't like the casino sector right now. You know, if you check out my Twitter, it's at Ed Ponzi on Twitter. You'll see like I pressed a took a shot of a closed casino. I was in a New Jersey town not far from Atlantic City, and there's this huge casino looming in the distance. It's miles away, but it's massive, and it's closed because they just built it. They just opened it 2 years ago. It cost $2.4 billion to open it, and it's closed already. Because why? Because they're building too many casinos, folks. And these charts look awful. That's Las Vegas Sands. Look out below Las Vegas Sands. We took half of our TJX position and put it into LVS, and we took the a short position and took the other half and shorted Wynn, and which is also, it's the same chart as LVS, but it hasn't broken down quite as badly yet. So the 2 stocks that I shorted today, LVS, Las Vegas Sands, and Wynn, and they're both breaking huge support levels. They're both setting year-to-date lows. It's, you know, the charts look great for shorting right now. One other one that is in this sector, but I didn't touch it, was MGM. You'll see why. If you look at the chart, it's not quite as bad as the other ones. It's not hitting year-to-date lows, so I'll just leave this one alone for now. MGM is hanging in there better than Las Vegas Sands and better than Wynn. So that covers that. Now another stock that I'm thinking about shorting, it has to do with the euro. So stay tuned for that one. That's going to come up a little bit later. Next, I wanted to talk to you about the non-farm payroll report because I had a question. And I'm going to pull up the chart, and we're going to go intraday here. 5-minute chart. Oh boy, just dropped. Anyway, non-farm payroll report came out on Friday morning, and market went down, and then around a few hours after non-farm came out, it turned and went higher, and it closed near the highs. And a lot of people were saying, Ed, this doesn't make sense. That non-farm payroll report was really bad. Why did the stock market turn and go higher on a bad non-farm payroll report? Well, I think that's a fair question. So let's take a look at the non-farm payroll report itself. And let's see, was it as bad or was it worse? You know, was it better? Was it worse than people said? First of all, 142 is the headline number, correct? That's the one that everyone sees and everyone hears. That's the one that makes the news. But it's not the most important number in here, in my opinion. You can view this in relation to some other recent months. We went from 267 to 212 to 142. That's a pretty severe drop over the summer. 134 is the real number, because what's the difference between 142 and 134? 8,000 government jobs were created. And so because of that, I would say that, look, when you're trying to get the economy going, you're trying to create private sector kind of jobs, not government jobs. Anybody can create a government job. The problem is it's not self-sustaining. You're using taxes to pay people, and then those people pay taxes, but you have to keep paying out of the taxes to support, the salaries. It just doesn't work as well. You want private created jobs, and we got 134. We went 260, 213, 134. So far it looks pretty bad. Now let's go through this, because what I'm going to show you is this is not as bad as it looks. We got to be honest, folks. We got to be honest. There's so much dishonesty in media today. On Friday morning, when this number came out, the TV stations were spinning so hard to say that it really wasn't that bad. But they didn't take you inside the numbers. They just said, well, we don't like this number, so we don't believe it. And that's not actually a very scientific way of looking at things. We're going to look inside the number, and I'm going to tell you exactly why it's better than it appears to be. Okay. First of all, okay, we're step by step. 20,000 construction jobs, that's not bad. It's not great, it's not bad, right? 0 manufacturing jobs, okay, that's bad. Okay. So drop the ball on manufacturing. Manufacturing is important for more than one reason. See, both construction and manufacturing are it's more than just how many jobs. If there is construction occurring and we hire 20,000 people to build buildings, that tells you something about the economy, doesn't it? The fact that we need to build houses or apartments or office buildings, whatever the case may be, the fact that we need to build those things is a good sign. So we like that. Okay? Now, the fact that we don't need manufacturing is a bad sign. Why? Well, we have to manufacture things to sell them, correct? Like cars and, I don't know, also pens and pencils and erasers. I mean, name any item. You have to manufacture guitars in order to sell guitars, right? So if there are 0 manufacturing jobs being created, that's a bad sign for the economy. So construction and manufacturing are not just the number of jobs created, they are also indicators. The construction indicator I like, the manufacturing indicator I don't like. So far, it's a push. Okay? Durable goods, this was perplexing to me. Only 2,000 in durable goods, minus 4.6 in motor vehicles and parts. Now, this did not sound right to me, because auto sales supposedly are very strong right now in the U.S. So the fact that we went negative 4.6 on motor vehicles and parts, that seems a bit funny to me, like maybe it's not quite right, or maybe the counting wasn't done correctly or something. I find that one suspicious. We'll see. We'll see. If this whole month was an outlier, we'll know by next month, right? Now let's move on. We're not hitting every single point. I'm just hitting the ones that matter most. This section is very interesting. Private service producing jobs dropped from 226 to 146 to 112 over 3 months. Pretty bad, but out of that 112, I want to tell you, there's some good things in there. Now it's going to start. Now I'm going to show you some things that really are going to make it look a little bit better. Think about what are the good jobs and what are the bad jobs. In other words, retail is something. A lot of the so-called good jobs reports late last year were pumped up because of huge numbers of retail salespeople being hired. Those are minimum wage jobs, and they don't last. And we don't like it if you have a good number that's based on retail. Well, here we have a bad number. It has negative 8.4 on retail. I would say good. Why is that good? Well, it's never good to have minus sign in front of anything when you're trying to create jobs. But fine, these are not the good jobs anyway. These are not the good jobs. Where are the good jobs, I ask you? How about professional and business services? This line right here did pretty good, right? Went up from 36 to 47. Not bad. Let me show you some other good jobs. Healthcare and social assistance went up from 40.1 to 42.7. Now think about this for a second. Just take these two numbers, 47 for business and professional services. These are high-paying jobs generally. And 42.7 for healthcare. Those are high-paying jobs, doctors and nurses, etc. And add them together, 42.7 plus 47, it's going to give you approximately 90,000 jobs just in professional business services and healthcare. 90,000 good-paying jobs out of this 134. That's why the number is better than it looks. If you had had a big bump in this, right, in retail trade, then I would say this number is worse than it looks. If you had had a big bump in temporary help, and we, look, 37 was actually a lot of these jobs that were created were 13,000 of them were temporary jobs. If that had been 30,000, I would say this report's completely hollow. But 13,000 is kind of in line with where it's been, right? That's about normal. But you've got you really created 134,000 private sector jobs, and out of that, about 90,000 of them are good jobs, so-called what I would call good jobs. Maybe more than 90,000 of them are good jobs, but let's just say that at least 90,000 of them are good. Sound right? So I think you got to say the overall number, right? This report is a C minus, but the quality of the jobs brings it up to a C plus or a B minus, and that's good. A lot of the chatter also is that a lot of times August jobs numbers are revised higher over time. We'll see. We'll see that at the beginning of next month, whether or not that's true. But that's the scoop. That's why the numbers are the way they are. Okay, so a little look inside the employment industry. Now let's get to your questions. It's one of my favorite parts of teaching is answering your questions. And let's get to some of those right now. Let's talk about a great question from a friend of ours in Singapore. Gosh, we love Singapore. Such nice people out there. I read this news from Bloomberg. Euro drops. This is the question. This is not me talking. Here's our friend from Singapore. Here's a Bloomberg headline. Euro hits a 14-month low. Okay, the key message is that the ECB will do anything to weaken the euro, and Commerzbank forecasts that the euro will hit 125 by the end of March next year. So Commerzbank thinks the euro is going to fall 500 pips over the next 500 pips. Wow, this thing is still cratering right now. By the way, as I'm speaking to you, by the way, I don't know what's going on, but the stock market started caving in while I was speaking to you, and the euro started falling farther as I'm speaking to you, so I'm not sure exactly what just happened. Back to the question. Commerzbank says the euro is going to go down. I take it. If there's an opportunity, I'll short euro again. Thanks for the earlier calls on euro USD and dollar CAD. Kudos to you. But this said, what about the Euro-Swiss trade? I know that you're long Euro-Swiss. Will this have a great impact on your open trade? Or, do you think that this could actually work out in your favor? Pardon me. And by the way, I am thankful to have you as my FX mentor and coach. You are amazing, awesome, and a rock star. Well, thank you very much. That's awfully kind of you. Let's take a look at this. Now, okay, so Commerzbank says that the euro is going to hit 125 by March. By the way, I see the big support level being around 127.60. Bounce, and it's also the what? 61.8. If I measure from this low here up to this high, you get a 61.8 pullback right down here. Man, it looks like 129 is going to give way. And by the way, we made a bunch of money shorting the euro, did we not? I'm still smiling about that one, ladies and gents. we made about 350 pips. Now, since we covered our short, it's continued to fall. In fact, the fall has accelerated. You can't worry about stuff like that, ladies and gentlemen. It is what it is. Okay, as my screen turns red. all this stuff turns red. Okay. So anyway, do I think it's going to affect Euro Swiss? Well, let me put it to you this way. The euro is getting creamed by the dollar here, right? But you know what? The Swiss franc is also getting creamed by the dollar here. And look at the damage that the euro is getting done to it by the US dollar. This doesn't appear to be having any impact at all on Euro Swiss. It's still hanging around 120.50 where it's been for a couple of weeks. In other words, the euro has clearly been in free fall, at least since, for the past week. It's not going anywhere against the Swiss franc. It's holding very steadily. Now, that could always change, but do you see why I'm not that concerned? Because it's not just the euro that's getting beat up. Swiss francs get taken a beating up right along with it, and that's why when you match up the euro against the Swiss, there's nothing there. Another thing I would ask you to consider is that maybe, just maybe, the euro is getting overdone here to the downside. I do think it has more downside. I do think it's going to get down to around 127.60, and I would probably short a rally, but a rally at this point could be pretty vicious. You could see some vicious short covering at this point. There are a lot of euro shorts out there. The euro shorts are getting paid right now. And if we cover, if those euro shorts have to cover, then this thing could fly. Okay? So if anything, you want to take a look at how oversold this is right now. 16.72 on RSI. So it's not just below 30, it's below 20. I'm going to take you back and I'm going to ask you, how long has it been since the euro's been this oversold? I got to take you back to 2008. And that's the very bottom on the euro here. 2008 was with the last time it was this bad. It was actually a little bit slightly more oversold. It was a perfect time to buy. And I'm sure, as the price was falling, nobody felt that way. It felt like everyone thought it was going to parity. Do you remember that? If you've been trading for a few years, you might recall that everyone was calling for the euro to go to 1.00 against the dollar. And of course, it never got anywhere close to that. And now the same thing is happening. Now they're saying it's going to go to 1. I think it's going to go a little bit lower, but I don't think it's going to go to 1. I don't think it's going to go to parity. We're way oversold on this. This is due for a bounce. We just broke 129, by the way, as we speak. And the NASDAQ just turned red. Everything is red on my screen except the dollar. The dollar is the only thing going up. What do you think of that? Okay. All right, so hope that answers the question, right? I don't really think it's that bad of a deal. The dollar is wicked strong. The euro is crazy weak. All right, look how strong that dollar is, and just another strong day today. All right, and that leads me to another question, and we'll come back to the euro in a minute. So anyway, I hope that answers your question out there in Singapore. Thank you so much. Keep sending your questions in, ladies and gentlemen. Cobus asks, the market has gone up for a long time. If the market breaks down, can the blaster strategy be used in a bear market? If so, what will the parameters be? It's not designed that way, sir. This is from South Africa. So it's interesting that we have people from South Africa that are looking at U.S. stocks. But hey, it's been a great market to trade. I would not recommend trying to adapt the blaster for shorts. It's just not built that way. What we did do is I created something called the 2020, and there's a reverse version. There's an inverted version of the 2020, and all that's listed in the course. And that's what I would look at. I wouldn't look at the blaster. I would look at the inverse 2020 or the reverse 2020. if you're looking for something to short in case things get ugly. Okay, great question though. Great question. Yeah, some things you can flip them on their head and they'll work in the opposite direction, and some things won't. You know, some things just won't. And I think Blaster is one of those things that just doesn't work when you flip it, but you can flip 2020, and that gives you a good strategy. Right now, though, I mean, I'm 50% long and 50% short. I actually have 4 shorts and 3 longs, but 2 of those shorts replaced 1 short, so they're half shorts. You add it all up, it's 3 full short positions and 3 full long positions. Here's a great question about stocks. Ed, do I have to subscribe to Y charts to get the enterprise value and other valuations of stocks as you explain in the course? No. Although I think Y charts can be very useful. I think most of what you need can be found for free on the internet. I don't like doing internet searches with my laptop or desktop, because in order to trade, you know, and to use certain types of charts and to use certain types of platforms, it's much better to have a PC than it is an Apple in certain cases. So what I'll do is I always have, you know, an iPad or something like along those lines handy nearby, and I'll do the search on an iPad. So I can't really show you the search right now, but Y charts can be very useful for certain things, but you can get the enterprise value, the PEG ratio for any stock at all. All you do is type in the symbol and the words key statistics. So if I wanted Microsoft, if I wanted to know the enterprise value, or if I wanted to know the PEG ratio for Microsoft, I would type in MSFT key statistics. That's going to take you to Yahoo Finance, and you're going to see all the data right there in front of you. I believe I mentioned that in the course too, but it's all right there in Yahoo Finance, so it's great to have that. All right, so is the Y charts light package enough to get the required valuations? The truth is, I've never needed it. You get all the key statistics for free, and there are other sources you can use too. There are a lot of them out there. NASDAQ.com, lots of good fundamental information on NASDAQ.com. A number of other sites as well. Okay. All right, great questions. Now I wanted to talk to you about something that's been on my mind, and that is when the euro does a dipsy doodle like this and plunges, you know, like an aircraft making a hard landing, or when the dollar is doing this, it often leads me to think about what companies are going to be affected, because right now a huge difference, a huge movement has occurred in the euro-US dollar exchange rate. Up here, early May, that's about 4 months ago, almost to the day, the euro was nearly at 140. Today it's below 129. So euro has moved down 1,100 pips in 4 months. Now, Airbus, all right, Airbus and Boeing are 2 companies that are really highly impacted by this. A really strong euro hurts Airbus very badly. It makes their products more expensive. Just remember, a lot of the buying for airlines, a lot of the purchases, almost all of these purchases go to either Boeing or Airbus. Nobody else is manufacturing these massive jetliners. Bombardier in Canada does to us, but they're really much smaller. It's Boeing and it's Airbus, right? So if the euro is plunging, who's buying? A lot of the buying is coming from developing countries buying these airliners. That's where all the new buying is coming from. So if the euro is getting cheaper and the dollar is going up, what do you think they're going to buy? Do you think they're going to buy an Airbus from Europe, or are they going to buy a Boeing from the United States? Truth is that when the euro drops 10 cents like it has over the past 4 months, that adds about €1 billion to Airbus's bottom line. €1 billion is about $1.3 billion. And if they're gaining $1.3 billion, where do you think it's coming from? Well, their main competitor, Boeing, the dollar is skyrocketing, right? And so if you're, let's say you're in Japan or China or Brazil or any country that is not in Europe and not part of the United States, and you could say, well, man, these Airbus planes are getting cheaper, and these American planes from Boeing are getting more expensive. I'm going to buy the Airbus. And believe me, these are very expensive airplanes, so that discussion does occur. It's not like they're buying, something that costs $5. They're buying jet airliners, so the savings becomes huge. All right, on a per product basis, it's a huge amount of money. The difference is just tremendous. Plus, they don't just buy one jet at a time. A lot of these countries will buy 10 jets at a time. Think of the amount of money, and then the exchange rate moves. It's a huge difference, okay, in the amount of money spent. Okay, so you take a look at the overall stock market, which is doing okay. Still above support here, right? Now look at Boeing. Let me show you Boeing. High, lower high, lower high. Descending triangle, right? Flat here, down here. Let me show you something. Put a little moving average. We'll put a 50 and a 200 in here. Boom. What do you see? 50 crosses under the 200. Now today, Boeing is up. Boeing's having a great day today, which makes it a great day that if you're long Boeing, today's a great day to get out of it. Why is Boeing up today? Because a nice article came out over the weekend in Barron's, and they said the stock's going to 150 and everything's wonderful. But you know what Barron's article did not mention? It didn't mention the euro, because these guys, they're not currency people. They don't understand what's actually happening beneath the surface. Currency guys and gals understand that it does make a difference, but that's okay. These people are buying today just because of some article in Barron's. They're walking into disaster, quite frankly, in my opinion, or they could be. Anyway, I'm not shorting it here, but I'm definitely not buying it. I think that the weak euro is going to, it'll take time. It'll take time, but the weak euro is going to hurt this thing. And eventually it gets under this level. What can happen? Look how much it's run up. There's a lot of downside to Boeing. I mean, it could come all the way down to this area down here, down to 70, 75, right? That's a long way down. So, this is the type of thing that I'm thinking about as a currency trader and a stock trader. These are the type of things that are on my mind. I know the euro is making a big move. What U.S. companies are going to come out and say, we were hurt by a weak euro. We were hurt by Europe. Boeing is a good example of a company that fits that bill. Okay? All right, that's going to wrap it up for today, ladies and gentlemen. Thank you so much for listening. We'll be back in just a couple days with more. It's great speaking to you as always. My name is Ed Ponzi. I'll speak to you again very, very soon. Everybody have a wonderful day. Take care. Hey, Rick, can you hear me?